You're talking about, Reema was talking about Shriram Finance, and indeed we have the management with us. Umesh Revankar, Executive Vice Chairman at Shriram Finance, is joining us. Mr. Revankar, good morning and thank you very much. Apologies for the bad telephone line last week, and very nice of you to oblige us a second time. Well, as our previous guest was telling us, Mihir Vora, how do you see loan growth in 2025 and more particularly in FY26? Do you think it can be good, because we are seeing so many warnings on unsecured loans, consumption not doing too well?
Yeah, good morning. I personally believe that 25, 26 should be very good, mainly because, see, one of the main reason why I feel there was a little slowdown in the pickup in credit was the infra spend by the government was much lower than expected. And that has a major impact in the consumption pattern and also the migration of labor, because a lot of unskilled and semi-skilled labor get migrated to urban centers for the job when there is infrastructure spent. That was a bit lower in the last 2 quarters, and it is picking up now. And that will have a major positive impact going forward in the next full calendar year. I believe next calendar year, the growth rate would be much better, and credit demand also will grow accordingly.
So do you have a range in mind, sir, for credit and loan growth next year? What are you targeting or hoping to achieve?
See, from Shriram side, we would be happy to grow anywhere between 15 to 20%. That is because we would always be very conservative in both planning and estimation. And but industry can grow. Industry may grow, especially NBFC credit, compared to what it has been in the last 2 quarters.
Okay. Well, we have to discuss the RBI Financial Stability Report. They are worried that, loans, multiple loans are being given to the same person. They're often giving consumer durable loan and maybe a credit card loan to a person who has an auto loan and a home loan probably. Now, you will not be in the personal loan segment, but you may have given them an auto loan, for instance, but that person has multiple loans. How worried are you of unsecured loans?
See, when we look at our customer, when we lend the money, when we look at the credit bureau score checks, we normally see that our customers have no other borrowing. At the most, he may have some gold loan borrowing. Otherwise, he do not have multiple loans, is what we see. Because most of our customers are in the semi-urban and the rural market. They are not typically they take the multiple loan, is what we, because this is our data and what we have. And there may be some instances where there is a multiple loan. In fact, many of the lenders today would like to give the multiple loan from the same institution so that they have a better track of his cash flow and his ability to pay. Only when he has a different loan at different places, then we have a difficulty in tracking his income versus ability to pay. We try to put things in such a way that we are sure about he's having enough source of income to repay the loan.
Sir, are you increasingly seeing more competition in the CV lending space? Because, margins are more lucrative. There are reports that banks too are muscling their way slowly and steadily into this segment. So first, tell us, what has been the competitive landscape last year? How has that changed? And your view going into next year?
See, we have been in this industry of this lending activity for a very long time. The competitive intensity was always there. It is not that today the banks or other lending institutes are becoming active. We have seen depending upon the various economic scenario, many of people become active sometimes little passive. This is the way the management reacts to different situations. So competitive intensity is always there. I don't see there is a heightened or increased competitive intensity now. It has always been there. And if you are carving out a niche area for yourself, then you are very comfortable in the niche area you are in. So many of the NBFCs, they have their own niche areas and they play around that niche areas. I don't think there is a direct competition, especially in the among the larger NBFCs for a particular space.
Okay. Can you cast your eye over the next 365 days and tell us how will cost of funds pan out for you? Will it be lower than it was in 2024? And therefore, margins, will they be like 50 bips higher, 40 bips higher? Any guidance for the 2025 margins?
I believe the first 6 months, the margins and the cost of borrowing would remain almost same. I don't really see significant change, because even if there is some change in the policy rate to translate into or get into the NBFCs, when it passes it on to the NBFCs, it may take a while. So I believe it may first 6 months it will remain same. Post that, there is a possibility that the interest rates can come down a little depending upon the policy rates and the liquidity that being available. So I feel over the year, if I say the second half of next calendar year, there will be around advantages of around 25 to 50 basis points. Overall net interest margin for us would remain same. I don't really see big difference, because whatever the benefit we get, we'll pass it on to the customer.
Yeah, and actually, Abhishek has given us a nice table of the NIM performance of all the big NBFCs, and all of them have dropped by about 10 basis Q2 over Q1, whereas you all have dropped only 5 basis. So do you think 8.75 is something you'll manage?
No, we'd like to be in that zone, but anywhere between 8.5 to 9 is a good zone for us. Okay. We would prefer to be around 8.75, that's the midpoint. And we are just hoping that we'll be able to manage it for next couple of quarters.
So 15 to 20% growth, top line growth, and margins between 8.5% to 9% is what you're hoping for next year. Any fundraising plans?
The fundraising for us is a continuous, because the raw material we need. So we are, so one thing about Shriram is we always been looking at new source, so that we are not over dependent on one single source. So the resource raising in various sources, or trying to see a new source which is likely to be more liquid at any point of time, is the our senior leadership has been trying to find it out all the time. So this is always there. So we are quite comfortable now. We have raised recently large sum. You would have noticed that we have raised 1.27 billion in the recent times. So we are very comfortable as far as the fundraise is concerned now. We are not really looking at any immediate fundraise.
Okay, just one more number. Your bad loans GNPA ratio. Again, you all were the only ones who brought it down, Q2 over Q1. Everybody else saw some 10 basis points increase. Are you sure with all these Reserve Bank warnings, you remain below? I mean, will it go down from 5.32 to 5.3, 5.2? Is that the direction?
See, we actually targeted to reach 5%. But depending on the economic environment and situation, it can vary. We are quite comfortable at 5.32. We feel like we have done a very good job. And we'll be happy to maintain at this level for some time.
Okay. Oh, certainly it's an outperformance compared to your peers. Mr. Revankar, it's always a pleasure having you with us. Thank you very much for giving us a macro and micro understanding of Shriram Finance and the NBFC space. And here's wishing you a brilliant 2025.
Yeah, wish you Happy New Year.
Thank you.